Hello, welcome to Betty and the Squirrel. It's quite a week we're having here. We're very lucky to have Danielle DiMartino Booth with us. We're going to talk about the Fed. We're going to talk about private credit. We're going to talk about NDFI. So welcome to Betty and the Squirrel, Danielle.
It's great to be here. Thank heavens we chose a boring day.
Yeah, guess what? In Australia, it's already Friday the 13th.
So I thought we'd kick it off because I think everybody who's listening to our show knows I've been a very adamant bond bull and a SOFR bull in the red pack, and we've had some damage this week. Let's say, what do you think's going on with the Fed? What do you think's going on with rates here? Is it inflation? Is it what's going on? Let's talk about that. Let's start there.
Okay, well let's do some basics here. It is not inflation. Okay, next. No, I'm sorry, but it's not. It's not. You do not have a situation in which wages are in a disinflationary mode. You've got layoffs through the roof. Maybe they're not being reflected in initial unemployment claims, but guess what? They only cover 24% of unemployed Americans in the first place, because in the last 50 years, what you get covered in terms of your living expense has been halved. It's now 33% of what you need to live. What are you doing? You're driving for Uber. Sorry. Because you're not going to not put food on the table. So this is not an inflationary issue. We're in a wage disinflation cycle right now. People are going to have less money to spend on everything else. And by the way, the current administration has just pissed through one big, beautiful bill's tax refunds at the same time. So there's even less money.
I mean, it is totally crazy to me how people don't understand when energy spikes. It's like it's a squeeze. It's basically primary money. And when primary money, like just if we thought about interest rates spiking, what does it do? It destroys demand and it sucks out liquidity. And so I think maybe we're in that part of the phase where we are seeing liquidity sucked out. Is that maybe fair?
It's really fair. And it couldn't have been at a worse time. I mean, look, I'm not some big proponent of if you take out the top 10%, but if you take out the top 20%, you've got household balance sheets in the United States in tatters. And people, the fastest growing area of buy now, pay later is dental bills. Let's get real. People are struggling here, and they did not have the extra chump change in their couch for the price shock at the gas pump.
So where does 20% of median income take you down in dollar terms in terms of household income? What is that? Is that about 100,000? Where does the top 20% take you down to?
Top 20% takes you down to about 120. Yeah, 120, 120. It's moved up over the last decade or so, but just think about it in terms of north of 100,000, which still.
So we're below the Mike Green line anyway.
Yes. There you go. Okay, who's going to count how many times we say Mike Green? Not me.
To be fair, Mike Green was at dinner with us last week too, ironically. Well, it is a little bit of a more intense play of last year, right? Like, tariffs come in, and I argued till my face was blue that it was deflationary and it was going to it's a tax. And now that, oil's ripping, it's just a huge tax. And when I see what jet fuel surcharges and fertilizer prices and et cetera, it's just like a more dangerous, crazy version of last spring, right?
Look,
into a weaker economy also.
Exactly. And it's weaker than it was a year ago. We saw something very unusual this week. We saw Trueflation, TRU, which is now in the Bloomberg terminal, so a lot more people know about it. But we saw Trueflation core fall below Trueflation headline. That's not bueno. That is no to the bueno. Look, home price declines are spreading around the United States. Rental disinflation was very apparent in the CPI report that came out. But everybody's just disregarding this. Because you know what? Because the Fed's disregarding it. And that's important. If the Fed's going to dismiss any and all data that goes against, that even begins to help President Trump, they're going to ignore it. And even when it comes, look, Ben Herzon is now at S&P Global, but he basically invented GDP modeling, GDP now. Everybody goes off of the model that he created years and years ago. Today, after all of the data hit, he came out and he was like, well, I kind of now see Q4 GDP growth as being 0.7%. He took it down by 0.8%. And guess what? Right now, there's not enough money in the budget for the BLS to interpolate out what 1 million fewer jobs, that has to come out of the income data, and that's going to come out of GDP data. So, but the federal, they'll ignore that too. The Fed is ignoring everything because there's criminal charges sitting against a sitting Fed chair.
Right. And so, you had wrote a piece that we were looking at, and you called it the Fed's blind spot. So it's kind of like they've always been way backward looking. Ever since I was trained by a great interest rate trader and I read the leg transcripts and all this stuff, they're always late. These guys are always late, right?
Yep, they're always late, but we know that the government shut down for a record period of time, and that a lot of Fed officials talked about alternative data sources. Look, they've all got access to it. They're just acting like they don't.
Yeah, I mean, I will say that also, as someone who's read a lot of the 5-year leg transcripts, there's a lot of charts in there that are looking at markets and credit spreads and swap spreads, and like they're looking at a little more stuff than I think you want to give them credit for. But maybe you're right. Is that a political thing then?
It's overtly political right now, and I've been saying this for months. They're not even pretending anymore. I mean, you have Fed officials come out and say the labor market's solid when the job losses are like the ink is barely dry. I mean, we've had 13 consecutive months. 13 of real-time downward revisions to payrolls. Back in 2009, we stopped at 11 months, but we passed that Great Recession record 2 months ago, and we've kept on going. I'm not talking about annual benchmark revisions, stuff that like makes paint dry. I'm not talking about that. I'm talking about real-time revisions that come out month after month after. You want to talk about those big fat revisions? We got the QCEW quarterly census of employment and wages out this week. Nobody paid attention to it. I did, because guess what? Payrolls averaged negative 70,000 in the third quarter of 2025. You've basically wiped clean the first 3 quarters of 2025, and you know that the momentum was going the other direction. The Fed's going to ignore that too. And by the way, all those PhDs love these big, meaty quarterly. They all know it. It's like they've been muzzled. So,
the other thing I think about is when I unfortunately started my career right before the market imploded in the GFC, and I was trading euro dollars, and I ran a bond fund in grad school. And I remember that period when we had the May, June, July energy spike, right? And rates rose, and it was like people were like, oh, the Fed's going to hike rates. And to be fair, they almost did hike rates. It was on the table for August of 2008. If you
the Europeans did.
5-year, yeah,
the Europeans did.
For somebody who was advocating for that at the time and hiding underneath my desk. Yeah.
Right. So, and then we just collapsed. So maybe that's a good segue into starting to talk about the private credit stuff and the credit situation that you've written about and you're talking about.
Look, you don't have to go backwards in time too terribly long to remember that the first time that we saw a huge disruption in private credit, that's when the 10-year closed for the week at 396. People are pretending like this contagion effect has disappeared into the ether just because we're at war.
Yeah, so we've tried to sort of lay out your thoughts in a sort of infographic here, Danielle, and I think we've covered off pretty convincingly the surface, the macro data that's being ignored. Let's dig a little deeper, and I think this brings us naturally to the shadow banking world and to the NDFIs and of course private credit, which is very much in the headlines right now. Which phase are we at? If we're going to do the 08 the 08 analog, which phase are we at right now? I think you've talked about the BNP moment.
So I think we should back up for a little bit, because we have to remember that we've had 4 years of extended pretend in CRE. So we can't forget CRE, because when banks' loan books seize up, it's because of what's visible on them. And we're seeing 87%, 90% losses being realized in office transactions. Distressed office transactions are at a decade high. That alone is going to pull banks back, because that's what regulators can see. They're less worried about what regulators don't understand and can't see, even though Jamie Dimon is, of course, this week at the forefront of saying we're slowing down lending into the non-banking sector. He can afford it. But a lot of the other ones can't. But I bring up commercial real estate because recognizing those losses is going to be a direct hit to liquidity at a time when banks are pondering, how do we pull more liquidity back from private credit, private equity? How do we do less NDFI lending? So it's important to realize that banks are going to first have their eyes on what regulators can see. Yeah.
Well, and so, in essence, we think about this private credit thing, they got a real funding problem on their hands, right? Because we have this, I think, Rupert, if you can find the chart that Danielle sent us with that shows the growth rate in NDFI, which was just out.
Well, the NDFI, are we going back to that one?
The chart that I sent you right before the show.
Yeah, exactly.
That we haven't been published yet, so exclusive.
Oh, so it's an exclusive to Benny and the Squirrel. We appreciate that, Danielle.
We're honored, Danielle. That's fantastic.
But,
this is
Rupert's yes, exactly.
Yeah,
there you go.
So you see, I mean, this is insane. I mean, you see if you're looking into the prism of Q4, you see that NDFI, that the growth has been 7.27%. It's second only, I think, to credit cards. But look at, we all know this, right? Deltas matter. And in this case, the growth rate matters, and it matters a lot because we've gone back in time.
And so if you think about it, then if JP Morgan had a headline this week that they were cutting back these lines, and they still have like almost $1 trillion of unused capacity, right?
That's
so
right.
as that comes up, and then it sounds like all these retail and equity guys in these funds are they're like, we want our money back, and it's we're starting to see a lot of gates, right?
Well, yeah, but they're going redeem, and they're like, okay, don't forget the fine print. That's up to 5%, less than or equal to anything north of it. Good luck with that. And what are investors to do? Actually, what investors do is they start selling what they have. They start liquidating other asset classes, and that's when things get really messy. And by the way, yes, there's up to $1 trillion of untapped lines. You really want to set off a panic. Those lines can be pulled back, and things will get really messy if that happened. But that happened. It happened in 2008. Banks can pull back lines of credit. They can do it. They don't like to do it. It's not good for optics, but they can do it if they feel like, I don't know, double pledging of collateral was systematic.
Yeah. The pulling, the pulling of RCFs was a big theme back in 08. Even up in high investment grade land, revolvers were just disappearing. They were evaporating. So back to the question then, Danielle, which phase are we at, right? I have to say, just Kunal Shah over at Goldman in London got the Tone Deaf Comment of the Year award for saying that the war was taking investors' minds off private credit. But if it's top concern in the B of A survey, isn't it just common knowledge?
Oh, it is. Look, it's all I talk about. It's all I talk about with most people I know, including people not in the business. Hey, have you heard about this fund and you can't get your money out? And, my broker sold it to me, and it is common knowledge at this point. It becomes more and more and more common though, every time there's another headline that hits, like, this isn't, it's really damaging when it's not just something that starts with black, but it's something that starts with Morgan and ends with Stanley. And that was kind of what, back in 07, it was just, there's some French bank over there. Who cares? And then it was like Bear Stearns, and they're, whoa, wait a minute. So, last night's headline that it was a Morgan Stanley fund that was throwing up the gate. That's a lot more recognizable to people than Carlyle Group or KKR. Some names they might not be as familiar with. Blue Owl.
And it also is just, I come back to what I said about funding. It always is funding, right? I like to think that the most mistaught or not taught thing is funding structure, liability structures in finance, because that's just where the problem always comes from, right?
And that is exactly where we're seeing the fault line, to go back to your crust analogy. And the issue here is that we don't know who all is providing the funding to whom. And this is where things start to get really dicey. Rubric Capital put out a great piece that was saying these funds are accessing leverage using off-balance sheet type of Enron-esque type of vehicles to hide the amount of leverage that they have. There was a financial stability report that came out this afternoon, and they're like, we think these cute little private equity funds are very well collateralized and don't have a lot of leverage. When the regulators are saying that, the banks are like, oh crap, we've got to take care of ourselves. And they will. And you're right. It all intersects at funding or lack thereof, right? Bear Stearns actually had full access to seven-day funding. But just a rumor hit the wires that they didn't have access to overnight funding, and they were done in 24 hours. It's confidence. Funding is confidence.
I agree.
Yeah,
I agree completely. And you've seen it, right? Like even today, like we had IG up like 6 to 8 bips, and high yield was down 0.8 or something like that. In price. Sorry, I don't want to screw people up. And meaningfully underperformed equity. So I just think we haven't really, 22 was a little, and you had the oil thing in 14, 15, 16. So we've seen a little credit, but we haven't seen a real credit cycle in a long time, right?
Oh, I mean, look, when SVB blew up, for example, triple B spreads. So that's like, your riskiest little slice of that, but still above that IG fault line, right? It was trading like at 200 bips, plus 200 bips. Today it's like 106. I mean, I guess the strangest thing is there's no bleed through into the biggest credit markets. And, you ask yourself, what if this is actually really bad news? What if what's being sold is, are the trophy properties, the most liquid names, the ones where you can most easily access funding for redemptions? And if that's the case, then what we're seeing in even IG spreads, it's a deception. And when you see things like that, then there's going to be a hockey stick, and then it's just going to go bunk, and you're like, whoa, where'd that come from? They've been so well behaved for so many years.
Yeah, I think as a guy who owns a lot of CDS, it's been frustrating to the liberation, we got to move, and then now we're starting to get it, but it's still. I was writing our LP letter, and I was like showing this chart. I was like, we're still so low compared to where credit spreads can go. And, everyone's like, well, there's the highest percentage of double Bs, and there's less LBOs, and there's just all these narratives. But I think it was really just, there was money chasing, there was too much money, and they're trying to yield pick up, and there wasn't enough issuance, basically. And now we're kind of facing a refi window, and you're facing the private credit thing. Like, doesn't this whole thing just snowball? I think that's what humans always miss. We're just linear thinkers. And it's hard to see the exponential nonlinear stuff.
And we're all focused on this one little area. We're all focused on private credit, but people don't realize that, okay, you're talking about $1.82 trillion. Right behind it is $1.4, $1.5 trillion in leveraged loans. And that distress ratio, now we're back north of 10%, which puts you on par with SVB.
And I think that's why I'm so bullish on the SOFRs, is because, you can tell me you worked at the Fed. Ultimately, that's 350 basis points, 325 basis points of relief as spreads blow out, right? Because all those bank loans they have, all those private credit lines they have, that is the mechanism, and right?
People forget what happened in 2018, what scared the daylights out of Jay Powell. Spreads blew out, but then issuance stopped, and it's a process. And once, this week we've seen a whole bunch of headlines. This deal pulled, this deal pulled, this deal's back on. When you start to see tension in the issuance market, it's game over for Fed policy. They have no defense mechanism against an issuance vacuum, none. So every macroeconomic argument that they have, they all fall to the wayside if there's a liquidity vacuum, if issuance stops.
Yeah, that's perfect, because that's what I learned is coming up in the GFC. When I was at Fidelity, I was going around the halls telling guys to buy gold and sell stocks, and they were like, dude, we buy stocks here.
Makes you popular in Boston. Yeah.
but I had this understanding that it was like, no, if this all goes, it's a credit-based system. Mm-hmm. You don't even need credit to contract. If credit just flatlines, it becomes a huge issue, right?
That's right. Because you have to keep the machine going. People forget that the size of the credit markets they're like, but the bond market hasn't grown that much. It's just like 12 trillion. Who cares? Okay, fine. But there are these other avenues to leverage that have been created at the same exact time. When you add it all up together, it's like people going, margin debt's not that high. And I'm like, what about add in all these 2, 3, 4 time ETFs, add in other hybrid synthetic ways of taking leverage out. Did we have one-day options way back when? No. Oh, then now let's talk about real leverage that's in the market. When you look at it in the aggregate, when you look at corporate debt in the aggregate, 2007 is just, it's child's play.
Totally agree. Like the amount of, I think there's 12 trillion in repo. And then, the other thing that our mutual friend and friend of the show, David Dredge, likes to talk about is the OCC. The amount of leverage that's coming out of the OCC is outrageous and wildly not talked about.
It's
funny. That numbers game is so funny. I was a very junior banker at Barings when it went bust in February 95. And the balance sheet hole was, wait for it, 400 million sterling. Right, we're just dealing with different order of magnitude commas and zeros these days.
Well, I mean, I remember when we bailed out AIG and it was a big deal, and it was 87 billion. I mean, after the pandemic hit, the Fed was doing 100 billion of QE a day. So, but again, the growth of leverage markets demands that every time the Fed comes in, they come in bigger. And we don't talk about 25 basis points or 50 basis points. We talk about how quickly we can get to the zero bound so that we can relaunch full-blown QE instead of this cute little stuff we're doing every month at $50 billion just to help the mechanics and the functionality of the markets and ensure smooth blah, blah, blah. But it is $50 billion a month.
What do you think happens to the long end in yields this time? Right? Having said no mass so many times, do we get that steepener back?
I think we do. I mean, I think we have to. But again, I'm going to take you back to 10 days ago when the 10-year broke 4% to the downside. You'll end up seeing a curve-wide phenomenon, in my view.
Yeah, so, I mean, it's. I mean, I can get really comfortable alongside Benny in the slit trench in the Z27 sofas. I'm still minded to be short the long bond.
Well, when it hits a ceiling,
at least with an option. At least with an option with defined loss parameters.
What we haven't talked about is the actual increase in yields and what that's going to do to credit. Now, I realize I just said something very, very basic, but in September 2022, when we thought the world was coming to an end because the Fed had just raised rates by 75 basis points, the Fed funds rate was 50 basis points lower than where it is today. So people forget, and now I'm going to sound like a crusty old central banker, people forget about the lag effect. And the lag effect continues to percolate its way through the bankruptcy cycle, through private credit, through everything, ... But yields are rising. That means that if it was problematic 2 weeks ago, now it's just flat out dangerous. And you're talking about funding getting harder and harder and harder when liquidity is coming out of the system because of headlines. But yields matter. Yields matter a lot to borrowers who are banking on yields falling.
Yeah, and there's also a huge net or unrealized loss on the bank's balance sheet. So these assets aren't necessarily able to be used for liquidity if they want, right?
Nope. And that's something that also hasn't gone away. Just because the Fed's lowered interest rates a little bit doesn't mean that the unrealized losses have disappeared. They'll disappear if the Fed funds rate goes to zero. But if the Fed funds rate goes to zero, who cares? If you're a bank, you're out of a job. So I don't mean to be talking in circles. It's just what got us into this mess in the first place was a ton of financing done predicated on the assumption that we would stay at the zero bound and that you'd never have Dirty Harry in the Eccles building, AKA Jay Powell, keeping interest rates this high for this long. It's just nobody That was nowhere in anybody's scenario analysis. And here we sit today still in a higher for longer environment. That can't be ignored because it's going to percolate through every single pore of this economy.
So what do you think then? How is this going to play out? Like, when are we going to start cutting again? We're going to need to get rid of old Jay, and then
well, you got to get rid of old Senator Tom Tillis. I mean, from the great state of North Carolina. So I mean, he said he had a great meeting with Ken Warsh this week. Loves the guy. He's known him since he was in college. Just cannot be a greater advocate, cheerleader. Let's go, Kevin Warsh. ... As soon as these criminal charges are dropped against Jay Powell. I think the most important headline of the week is that there's a new prosecutor that's been assigned to the case. Maybe that's this administration's gentle way of saying we're moving towards these charges being dropped because we're freaking out because in T-minus 2 months time, Jay Powell's supposed to be out the door and we're supposed to have Kevin Warsh in there. And we need time to get his vote through committee. We need time to get his vote through confirmation. Worst case scenario, I mean, if the administration doesn't, if Scott Bessent doesn't pull out all of his political capital to make this happen, Tillis does not leave office until January the 3rd. If there's a blue sweep, and right now Kalshi tells us there's a 47% chance of the Senate changing hands. Forget the House, that's going to change hands. But if there's a blue wave, we may never have Kevin Warsh. So but Bessent knows this. He's not an idiot. So
why are they holding out on this political prosecution thing?
Tom Tillis is right.
Why is the administration so adamant about about?
I cannot answer. If you make me answer for impulse in chief, no, I have no answers. No.
Fair enough. Fair enough. It doesn't make any sense. Or Bessent has not explained the implications of pressing with this properly.
Bessent keeps saying we're going to push Kevin Warsh through, and Tillis keeps saying I am one person in front of a committee who can prevent that from happening. Come back to me when the charges have been dropped. Why this didn't happen months ago, where rates would be had this already happened, they'd be in a parallel universe lower.
Totally agree. Like it's bananas that we're at this rates right now. It's bananas. We should be 100 bips lower minimum right now, I feel like. And
we absolutely,
and it's unfortunate because now this oil thing like makes people think because it's just this misunderstood thing that's always going to cause inflation. No, it's going to cause prices of stuff to go up, but there's going to be a lot less stuff bought, basically, right?
It's going to cause the price of one thing to go up, which is going to make the price of everything else go down.
Yeah.
And by the way, it's, we're talking about banks and commercial real estate. Forget about lending standards to households. On July the 1st, there's new student loan requirements that come in. Credit to the household sector right now is severely impaired and too expensive. And to small businesses. You could, again, I never thought we'd be talking about Jay Powell being in office in January. And I never in a million years thought we'd be talking about small businesses being choked off and households being, just annihilated this many months out from a midterm election. This is just political suicide that we're witnessing.
Okay, let's try to pivot slightly, and let's say.
Thank God my Apple Watch.
Let's say the barriers are cleared, and we get 150 basis points of cuts. Mm-hmm. Is that enough to restart housing? Is that enough to start to cure what's been going on in commercial real estate? Where are we
So
the world never ends. The world never ends, right? We find a way to muddle through every time and always. But what is enough at this stage to set the ship straight?
I think we'd have to have private credit never marked to market.
Yeah,
because,
well,
again,
I wanted to come back to this. Danielle, because ultimately the shadow banking world is a feature, not a bug, right? Because the mortgage crisis was funded with overnight borrowing out of Japan, mm-hmm. we created the shadow banking world, and shitty software loans are being stuffed into unregulated insurance companies in the Caribbean. Now, they can stay there, right? They can stay there. So
As long
part
as the
of
person whose policy
part of
is
that,
doesn't die.
yeah, exactly. So
Inconvenient.
you can literally cut adrift that sort of deferred loss in the insurance company land, if that's where it, if we're to believe that is the case, and then redirect the firepower to fix parts of the credit market that are mark to market. Is that the way out here?
That would be the way out. But I mean, that would be quite the hat trick, because again, we have the reality of baby boomers dying. And so they actually need the proceeds of their life insurance policies, and they're not necessarily on shore. I mean, the largest seller of annuities in the United States last year was Athene.
Interesting. I'm sure you saw it. Steve Eisman interviewing this insurance he was from Mississippi, an insurance controller.
Yeah,
right? It was the most fascinating hour that I've watched for an age. And I obviously watching the KIE ETF like everyone else at the moment, but so much of that's like an equal weighted, and it's got a whole load of P&C insurers in there, trying to find insurance companies domiciled in those sort of rogue underwriting states that he talks about. It's actually quite hard. And as you say, Athene, well, would have been a canary, but that's been taken private again. I think there is a Blackstone, is it F&G? There is a Blackstone related lifer that is still public, and that looks very sick indeed. So I think it's one that's just gone straight up onto my watch list to take a look at every single day.
But you're also starting to see pressure in the broader insurance ETF. And that's something to keep on your radar screen, because we can talk all we want about the Caymans or Bermuda, but the fact is, unrated private credit is sitting on the balance sheets of some of the biggest insurance companies in the world. Just because they're not playing the same games as the private guys are playing doesn't mean that they don't own a whole bunch of it, because they were looking for yield. And these are massive companies.
And that's before you even start on the pension funds that have been hoovering this stuff up for since it started. And this is what bugs me is that it's not just a rich people problem. These are public sector pension funds that are loaded up on this stuff. So ultimately, what are we looking at? We're looking at a bailout of the life insurance industry.
Well,
is that how this?
You can't let them fail. I mean, that's how you bail out something that's regulated in 51 states plus Washington, D.C. I don't know. That's above my pay grade. But you could never let that happen. But on the other hand, you can never let any of these non-banks go. Forget insurers. You can't let the non-banks go. They're bigger. They're as too big to fail today as the banks were in 07 and 08. They're too interconnected. The conduit back into the conventional banking system is just it's the tie that binds, and it's regulators cannot get a grasp on NDFI lending. So right now, everything's too big to fail. And that's kind of scary.
Which is why rates are going back to zero.
Well, they have to, because that is the Bernanke doctrine. I mean, I wrote about that in 2007. It was decided inside the Fed, by the way, not with a full legal quorum, that you must have interest rates at the zero bound before you can embark upon large-scale asset purchases, aka QE. So one must precede the next.
Yeah, we've got the S&P sitting just single digits below all-time highs right now.
4% off its high.
Well, it's possible that the S&P is the new bond market in some sense, right? It got so big and it's so globally owned that if that thing fails, we get a huge move. That is maybe the systemic thing in itself.
I mean, look, I'm the wrong guess, but passive is the most systemic thing I've ever seen.
Yeah, we did a show with Mike on that, and we got into it pretty deep.
Yeah, I mean, look, But even the zero bound presents an existential risk, because you're not going to have a bunch of 75-year-olds going back into the job market, but they need interest rates to be positive. They need their cash saving rate to be very positive. And by the way, they own like half the stock market, people 70 and older. So the Fed's not going to have the Fed's not going to gain the same traction that it did in 01 or in 07, 08, excuse me, just by slamming interest rates down, because you have this demographic thing that's impeding your path. The Fed that's what nobody wants to talk about. What if the Fed put itself is not as strong as what it was in 08?
And you know why it might not be as well? Well, because there is no policy response to this oil situation. There's nothing the Fed can do about physical, like things that settle on physics, right? So we have that. But then we also have something that you've written about and we've talked about and everyone's talking about, which is this AI thing. And, I'm involved with an AI company and I'm seeing it firsthand. Like Oracle just fired 45,000 people or something, right? Like this, and these aren't McDonald's jobs. These are jobs that are pay really good money and have stock comp and all this stuff. And that's now going to just accelerate these deflationary trends we're seeing. And, as somebody who's seen it, like we're not even getting to the point where the architecture is going to improve and the token compression and then maybe the CapEx boom itself. So there's just a lot of things that like tell me rates are going back to zero, I guess. So what do you think about this AI thing? Do you have any opinion?
According to Fed officials, it's structural and something that monetary policy cannot address at all. So they're like slowly but surely emptying out the cupboard. Nope, we can't do that. Nope, sorry, we can't do that either. Serious distress in the job market, I don't care where it's coming from. That is something that the Fed, at least until the law is righted, and I don't advocate for the employment mandate. It's inherently conflicting with the inflation mandate. But until the law changes, they're not allowed to just label something as structural and say that they're stepping back from their duty. That's a no-no.
Right.
And the longer they throw red herrings out there and take away their ability to address things, the worse the liquidity gets. So you may not see it in the S&P 500. People's 401ks continue to contribute and they feed this passive machine. I get it. But you're only going to be able to go so far with credit before the Fed has to respond. And then they eat their words. Then they're like, okay, zero bound.
How fast could it come?
Well,
assuming this logjam moves, right? The Tillich logjam.
If you think about the not QE era, right? The U.S. economy was going into recession of its own volition in 2019. It was sliding into a plane.
Totally agree with that. Yes.
And the market was like, this not QE is not working anymore. We really do need QE. And the Fed's like, but everything's fine, hunky dory. So they needed a shock. And the excuse of COVID, and I'm not trying to be insensitive, but they needed a global pandemic. They needed an excuse to come in guns loaded because the funding markets were telling them not QE's not enough. We need the real thing. And they were in a very bad position because they couldn't do it without some kind of a calamity. So
we've got a war in the Middle East. How's that for size?
I don't know. Ask Senator Tillis.
But I mean, look, back to your point, as someone who was very long SOFR back then too, I remember in the Q4 18 when Jay Powell was kind of the same as he is now. He's just a gunslinger, like, hey, we're not even thinking about thinking. And then we had Jay Powell steals Christmas. If you guys remember, that was a nice Christmas gift of the S&P down 5% and Christmas Eve for the half day.
Benny, back up. That's what I was alluding to earlier. No. It was the 41 days of no high yield bond issuance that preceded the Christmas Eve bloodbath that caused him to get up on stage with Bernanke and Yellen on January the 5th, 2019, and say, I was young, I needed the money. I really love QE. I mean, but that's how that happened. But it started with credit. Christmas Eve was preceded by 41 days without a junk bond sale.
Yeah, I remember that actually. Now you say that. That was crazy.
But the stock market held off until it didn't, because the cracks in credit got deep enough that people don't understand. It's not stocks that go first, it's credit.
Yeah, I'd like to say that the stock market is the absolute dumbest macro product there is. And it's only gotten worse because of, what Mike Green talks about with the option sellers. There's just a lot of non-thinking participants in that market. And you only need to go back to COVID. The high, we hit an all-time high February 18th. Well, oil and copper and some of these things were already telling you things weren't okay. If you were on Twitter, you could see what was going on. We hit a high last year before Liberation Day, February 18th. It was very clear about the tariffs thing. So the stock market is not a leading indicator. Is that a fair way to put it?
Yes.
I like Jeremy Grantham's Brontosaurus, right?
I say stop.
Got bit in the tail about 6 months ago. It won't know about it till about 6 months ahead.
I asked Bank of America, Michael Hartnett Flow Show every Thursday night.
Yeah.
So I asked Michael a few weeks ago, I said, would you go back and get me your fund manager survey from 2007? I want to know what people were saying in 2007. So in September 2007, 74.5% of global fund managers said that liquidity was abundant. And in October, it was like negative 10%. So it was the flip of a switch when liquidity went funk. But people's perception of liquidity in September 2007, 74.5%. Today it's 60%. But liquidity is visible and abundant if you're blind. And then all of a sudden it vanishes, unless you're paying attention to credit, unless you understand that the MOVE index for a time gauges treasury market volatility. But when the MOVE index gets high enough, it's flashing credit. It passes a certain threshold and we're not having a treasury discussion anymore. We're having a credit discussion.
Yeah, I mean, when volatility, I like to think of volatility in this world, in the carry regime world, as the true price of money. Because when you get volatility, whether it's rates volatility or equity volatility, or right now we have 120 oil volatility, that's when, you got to deleverage the credit, their margins go down, et cetera, and you don't have the leverage world that is in the middle of the curve that you're used to, I guess.
That's exactly right. And look at where MOVE is. And you could draw a line back to when yields were 4.25% on the 10-year. You can draw a line back and the MOVE was a fraction of what it is today at the same level of yields.
Yeah.
So
the time series of MOVE, I've heard Harley Bassman, who obviously invented it, talk about it. I mean, the time series of MOVE, you have the pre-2022 MOVE, where there was zones that made sense. And then there's I'm still trying to figure out in the new sort of up to triple digit MOVE world where the real stress zone is. Because, 6 years ago, 85 MOVE would be hiding under your bed, right? And now it's kind of, yeah, okay. So where is the new stress zone in MOVE? Where do we start ringing?
I mean, you're not pushing Jay Powell the way that you should be able to right now. It's a higher threshold. It's a higher pain threshold. Something really bad has to happen, not just kind of bad. I mean, step back. What we're seeing unfold in private credit, despite the distraction of war, is extraordinary. And it's happening extraordinarily fast. We're not talking about small firms here. And yet, Jamie Dimon's the only one who's actually come out and gotten ahead of it and said, I can handle this. Nobody else has, because nobody else can. I mean, PNC Bank, the second biggest NDFI lender, that was one of them that was on regional bank SOS screens when SVB blew up.
Yeah.
And to know, and to learn that Wells Fargo just had its cap removed, 5 minutes ago, and it's the biggest NDFI lender.
That must have been a clue out the door.
What are they making for lost time?
Well, do you remember when Merrill Lynch got into the CDO game a little late? Right? Right? Like sometimes these lesser investment banks jump into the game that's like the hot game after the game's probably not optimal to play anymore. Actually,
the elevator couldn't come quick enough. I went running up the back staircase up to the 14th floor where Fisher's office was. And I'm like, 13 cents on the dollar. Thing took 13 cents on the dollar. And I'm like, well, last mover disadvantage. But he had a nice trash can.
And so when we think about this, all right, so we have this labor market that's weak and maybe getting weaker secularly from the AI thing, to be determined. But, it seems like the writing's on the wall there. We have, what we're all on this show saying is a shock that's deflationary as it squeezes.
Mm-hmm.
We have a credit situation that has definitely got some issues, and that is by the day, by the headline, becoming more and more, you can't deny it and you have to admit it. And we have banks saying we don't want to give money to them. And yet we have rates here. So like, why is this picture so easy for me to see and it's so hard for the market or the people? Is it just because the Fed's holding pat and they have a monopoly on the price of the most important currency in the world?
They do right now. I mean, this is really, really, really asinine what's going on at the Fed. It is diabolical. It is. This is a dereliction of duty, the likes of which we've never seen. On the other hand, presidents used to beat up the Fed, in private quarters. I mean,
yes.
this is, and by the way, there were never criminal charges running around out there.
Yeah.
I mean, what Tillis said a few days ago, Senator Tillis, was there are 7 witnesses who listened to Powell testify who can substantiate the fact that he did not perjure himself. Can we move on? Again, Scott Bessent is to me right now, he is the absent Treasury Secretary. It is his job to take care of this mess, and he's not doing it.
Do you think he can?
Well, not yet. He was pretty efficacious in his role for a while. But I mean, like, we're going to buy $200 billion in mortgage-backed securities, and mortgage rates are higher today than they were then. I mean, you can't do little itty-bitty things. We're going to buy off-the-run treasuries. Oh, look, the treasury's stepping in. And I'm like,
we're gonna hammer the paper crude market. That was this week's special.
Again, but traders don't buy it, nor should they. They're little Band-Aids. Whereas if you want to change the cost of money, you put somebody in office who's actually going to play ball and listen to the data. I mean, the saddest thing is Powell's among the most dovish. He knows this. He was one of the first Fed officials to say at the podium, we know revisions are going to wipe out job growth. He knows what's happening in the real economy, and his hands are tied because he's first and foremost Jerome Hayden Powell, Esquire. He's an attorney, and you don't launch criminal charges against an attorney. I mean, it's going to piss him off.
Yeah, it'll be interesting when we go back and we have you on the show in 5 years and we talk about, wow, that was all crazy, because it just feels like there's so much going on now.
I would kill to see the transcripts. I would kill to see the FOMC transcripts.
Oh, totally.
5 years from now, I mean, the Fed staffers in Washington, D.C., their heads have to be blowing up right now. That they're making presentations. They're like, well, we first thought we had 77,000 job gains in the second quarter of 2025. As things turn out, it was negative 396. And Jay Powell's like, there's the door. Bye-bye.
Danielle, can I ask you something as someone who worked at the Fed? I in my career, I read all the books and I read the 5-year transcript. So I trade SOFRs and Eurodollars. So I've always, as an outsider, pay attention. What is the culture like there? Is it a culture of like get in line, or like what is that like there?
It's painfully calm. I mean, we're talking about people with leather patches on worn sweaters, cardigans, leaving for lunch around 10:55 and coming back around 1:15. And you're like, wait a minute, the world is burning down and the market's open. Even if it was just any old given day, I'm like, the market's open. Always not a day for a 2-hour lunch. I mean, you're talking about 1,000 PhDs. You're not going to get much done with 2 PhDs, much less 1,000. But there is the sense of urgency, even at the New York Fed. is not there, and it's not what it needs to be. The only time you've really got a true top caliber talent inside the Federal Reserve is when there's blood in the street, because that's when, if I've been at some big investment bank and there's a mass layoff, fine, I know I can go get a job at the New York Fed. But the minute the street starts hiring again, there's a talent bleed. But there's the sense of urgency is simply not what it needs to be. I mean, it's like seasonally adjusted thinking. I walked in the door and I'm like, has anybody noticed that these CMOs are blowing up to Kingdom Come? And they're like, Bernanke says it's sustained. And I'm like, really? Oh, I feel so much better. You have a good day too. It was just the belief from the speakers on high is just insane.
I sometimes think I think with a lag as well.
That's called
I get in terms of, I come up with an idea that works really well about 9 months later. So I need to I need to trade with a lag.
You just need a time machine. That's it.
Yeah. Trading would be a lot easier with a time machine for sure. But maybe it's because there's no P&L, right? Like, I mean, I think when you have a P&L, you have a track record, you have other people's money or your own money at risk. Mm-hmm. Your attention goes up a little bit, and your sense of urgency goes up. So maybe like this like your comparison of the Fed being like the post office that's what you can give it to. Well,
I mean, in 2011 they changed the law. They were like, it doesn't matter what the magnitude of the losses that are racked up are, no harm, no foul. It's in the law. The Fed can be the most money-losing entity on the planet. It's in the law.
They have lost some money, right? Like in 22, if I remember, they lost. I think it started with a T. Their number.
The Fed is a deeply insolvent bank. It is,
and so that's actually a really good point. Is there a risk at some point? Because now, if we're charging the Fed chair with criminal, and there's a weakening of the Fed, which I've heard you talk about, and when we were at dinner, but then also in other podcasts, is there this like godlike belief that could be challenged? Because central bankers, to me, are like the Wizard of Oz, which was written about central bankers, and when Toto pulls the curtain back, and he's like, "Oh, you're just a mustache man." Like, is that a risk that you see?
So, I mean, I think let's just say that the criminal charges are dropped tomorrow. So there's a clear pathway for Warsh to waltz in on May 15th, and it's just a traditional change of the guard. There is so much dissent and agitation inside the leadership of the Fed right now that they might not be cordial about, this is our new leader, we will follow his path. That's a risk. It's a real risk. I mean, I give them ideas all day.
Then we're going to go, and then we're going to go back to those discussions that we were having a few months ago about,
if
changing the voting.
Continue to break, none of it matters because they have no defense. They're academics. They will acquiesce to the markets if the markets absolutely collapse. You walk in the door and you learn lag effect, lender of last resort. They will not let systemic risk come loose.
So let me ask you to be a little more proactive, that rather than just criticize, what would you prescribe as a way that things could get better there? Because like Rupert said, the world doesn't end. Like, how can we make this, what's your prescription for a better situation?
I think a solid dose of honesty would be great. Hey, look, the zero bound didn't work. It was a failed experiment. We know that we are in we're the frog in the water and the water's boiling on high. We get it. So we're going to take the Fed funds rate down to 2% right now. We're not going to quibble about 25 basis points, 50 basis points, but it's not moving. That's the new floor because the zero bound did not work. And by the way, neither did QE. So, but we're going to leave it to the Treasury Department to play a more proactive role in ensuring liquidity in the risk-free asset of the world. We're going to make sure, Mr. Dredge, no, sorry, quoting the wrong person. We're going to ensure, he was sitting right here to my right. But we're going to ensure that we have central clearing of treasuries so that we're not always the structural fallback for the market. You have we can centrally clear a stock transaction. So centrally clear the treasury. That's going to do a hell of a lot more for the functionality of the dollar market and the treasury market if it's centrally cleared. It will make some very large hedge funds not so happy, but grow a pair. We need adults at the Fed. We need adults at the Fed who are not intimidated by these massive players in the markets. We just do. And if they do the right thing, they're independent. They don't have to do anything that Congress or the administration tells them to do. They can set policy, and they can say, you know what, whatever's going on at the Bureau of Labor Statistics, whatever's going on at the Bureau of Economic Analysis, it ain't working anymore. So there's a new sheriff in town. We're actually going to pay. And by the way, there's AI, there's big data, there's all these fun little toys that we have. They don't cost that much money either. So we're actually going to start following a more rational set of data so that we can be more on top of making monetary policy. These are not difficult prescriptions at all. Central clearing of treasuries, 2% as the floor, jettison QE, speak honestly, use alternative data sets. And then you can hire like 700 PhDs.
And
more AI. This time it's not AI. It's actually just true efficiency, better ideas, right?
Just any efficiency at all. I'll take it in any form.
Okay,
Danielle,
what
I don't know
does
if you
the
heard
road
that
like
efficiency and
between here and
government,
that?
they don't usually go together. Efficiency and government are not necessarily thought of in the same sentence.
That doesn't make it right.
But I agree.
So what does
I agree.
So Danielle, what does the road look like between here and that destination? Right?
Massive financial crisis and a collapse in confidence in the Fed. I mean, you have to have something crazy to reinvent the culture of the Fed. But we're in crazy town right now. I mean, this is as bad as I've ever seen it. I wrote a book about this stuff. I've never seen anything like this. And you know that there is, when you see these presidents of regional Feds come out and just lie about the data, you know that there is serious irritation inside the institution. The institution itself has been upset. And for them to be going against the grain of data to the extent that they are, they know what shelter inflation is as an input to CPI. They know these things, and yet they're ignoring it. They're denying their own ethos, to use your word. I mean, they are. And that's how disturbed things are inside the institution right now.
So basically, it's got to get worse.
I'm so depressed. And Danielle, usually it's my dog that's screaming in the background.
Well, I have two crazy neurotic basset hounds, so I mean, he likes to bark.
People who watch our show always make comments about Rupert's dog. They're like, they have a drinking game whenever Rupert's dog comes on.
But let's just say Crescent succeeds, right? I mean, sometimes when you get a new Fed chair, things are already breaking in the background. I mean, that's what happened when Jay Powell came in.
And to be fair, Bernanke came in and you had that little faux expansion, which was all just dollar weakness, credit expansion. So let's be clear, when we think back, the actual credit market cracked in 01, 02, and they didn't want to let it go. And so we sacrificed the dollar. And I remember being in the south of France the summer of 08, and it was 162 euro. It was not fun. And $2 pound sterling, and the dollar, they just tanked so bad. And I'm sure you were at the Fed at this time. Do you remember when they stopped giving the M3 statistic?
Yes.
That was outrageous, right?
Don't tell. Don't look, don't tell.
And they said it was because of cost. The guys who can print dollars.
But see, we're having this discussion after all of the credit excesses have occurred. There are not many rabbits that can be pulled out of a hat at this point. I mean, if you can look past what happened during COVID, this expansion's been going on for 145 months. It's a long time to drag something out with credit.
It really has. And it's funny because, when you think about back to the GFC, we had a lot of bad paper that was issued from 02 to 07. And we had to get through that paper. And then now we had a lot of bad paper between 2017 to 2000, call it 23, 22.
With an acceleration in 20 and 21. That was when all of these ARR software loans got put onto the pad.
Yep.
And remember, the refi cycle is like 4 years, right? Like 4.5 years. So
4.5.
Here we are, right?
Again, I don't think that there's a silver bullet at this juncture. There's just too much credit that's been extended. The leverage is too high, and it's also invisible, at least to regulators' eyes.
Going back to your sort of path, your ideal Fed destination, what do you think the path of travel for the dollar is? They let it go last time, but then we get back to the cleanest dirty shirt argument. I mean, it's a tricky one.
So actually, I think if the world woke up tomorrow and there were adults at the Fed and they were like, we're drawing these lines and we're going to be honest, we're not giving you forward guidance anymore. We're going to be data dependent, but we're actually going to use real data. We're not going to the zero bound ever. Don't try and press us. Our phone lines have been turned off. We're cutting Fed communication. We're not going to have all these people, at one podium after the next. We'll let you know when we meet. I actually think that would be a positive for the dollar.
It's interesting. What year was it? 1994? Before then, you had to look at the actual money supply statistics to see what they did. We should go back to that world. A little risk premium from that, right?
Why not?
They're in the market. Yeah, they're in the market.
I mean, look, the one thing that told us everything that we needed to know before and after COVID was M2.
Fair enough.
Indeed.
Well, listen, Danielle, this has been a little bit scary, but a really amazing conversation. Not that you need any
right?
Not that you need any introduction, but why don't you tell viewers where they can find Quill and the rest of your work?
So just Google QI research and you'll find everything you need to know. It's pretty simple. So, and if you don't already follow me on the platform, otherwise known as Prince, whatever it's called, X, Twitter, DiMartino Booth, please do so.
Danielle, that was amazing. Thanks so much. Thanks so much.
Yeah, thank you for coming on. That was fun and very timely topic. So we appreciate it.
Thanks, guys.
All right. Benny and the Squirrel out.